Hi, Steve Van Metre here, and welcome to your weekly economic update where we take about 30 minutes every Friday to try to make sense of markets. Well, it's a holiday, so they don't make much sense on a holiday when they close early anyways, but we'll make an effort at it anyways. Now, you probably are hoping I won't talk about the trade war, and unfortunately, I'm going to. In an indirect way, I'm not going to say this is a victory for President Trump because this wasn't his bill. This is a bill by Congress, a Hong Kong bill. So as you probably know, that after markets close on Wednesdays, which is kind of what President Trump does. If there's good news, he will announce it or sign it or do something with it when markets are open. If it's either bad news or news he believes is bad, he'll wait till markets close. Or he'll wait till the Chinese markets open and do it then. So anyways, he signed the Hong Kong bill, which not many people knew if he was or wasn't. There was rumors that he was, but there was a lot of time has passed since the House and Senate had passed the bill. And China immediately came out and said, we are going to retaliate. There will be consequences from this. We're going to retaliate and we're going to retaliate. And it stopped right there. There was really nothing else. And I say this is a victory for America and an indirect victory for the trade war. And the reason being is China figured out real quick, maybe they knew or maybe somebody told them, I don't know, that the details in this bill, President Trump already has the powers for the most part to do. He's just never activated them. And all this bill does is give him the opportunity to activate pretty much most of the things that he can already do. And so far, we haven't heard from China. Now, of course, people that are closer to this than I am feel that if China is going to respond, they will wait until U.S. markets are open. Obviously, we're open today, but on early closes that tend to come before or after holidays, a lot of big investors aren't in. They're off for the holidays. Maybe they're keeping an eye on their phone, what's going on in case something happens, but they're not there. So maybe Monday. But then the other question is, what are they going to do? And nobody really knows. But we do know that the economic data in China is getting bad. There's no recovery. I know a lot of people were hoping that China would lead the recovery, and so you have all these people front-running stocks. Well, good luck with that, because China's not going to lead recovery. In fact, they're having problems with bank defaults, and things are starting to get worse there. Why? There's a shortage of dollars. And as we looked at on Wednesday's video, if you missed that, you may want to go back and watch that, because we covered the best proxy for world dollar liquidity, because I only get the other half of the data on a quarterly basis, and it hasn't changed much, which is the foreign-owned treasury securities. So when we look at the monetary base on a year-over-year basis, it's still negative. It's still contracting. And that means the global pool of dollars continues to shrink. Well, when you have a lot of dollar-denominated debt out in the world, and it doesn't necessarily mean it's spawned out of the United States. I mean, you can be in a foreign country and borrow in dollars. Well, when there's a shortage, it's like musical chairs. At some point, everyone's going around and the music stops. The problem is when it stops in the global economy, there's not one chair that's missing. It's a lot of chairs. And then you get the domino effect of a global recession. So China is hurting for dollars, and it's getting more obvious. So why I say this bill was a win not only for America, but for the trade war is because, as President Trump has said himself, I'm the reason we don't have a deal. I am waiting for better terms or a better deal. Well, the U.S. economy may hold out long enough for that to happen. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. A little holiday lag on my reading there. So let's talk about today's update. We're seeing credit conditions get worse. And again, debt-based economies, which we are in, they expand as the debt expands. Not so much the government debt. Because if governments could, think about it. If the federal government could perpetually expand their debt, and you're like, well, they do that anyways. Right, okay. So if they could do it with effectiveness, if they could say, hey, we're going to expand the federal debt and everyone's going to benefit, the federal debt would just explode. It would mushroom, because that would be the solution to the problem. It's the private sector that needs to expand its debt, because the private sector obviously funds the government debt. Well, where does the government borrow from? They borrow from people who have dollars. Who has the dollars? Private sector. So the governments are funded by the private sector. And even Jerome Powell said recently in testimony that the government debt is growing faster than the economy, and that is unsustainable. It is a long-term problem. The reality is it's not even a long-term problem. It's a short-term problem, because it's happening, and it should not be happening at a time. Now, it wouldn't matter if we weren't borrowing a lot of money and running big deficits, because then you can get away with that. You can scale back government spending to balance it out. But when you're pushing the pedal to the metal on big deficits, and the private sector is not growing fast enough, it's a problem. So what we're seeing is this debt contraction. And you've heard me talk about and write about commercial industrial lending. But really, the only thing that's holding the U.S. economy up, and it's not doing a great job of it in terms of long-term averages, is real estate lending growth. And it's weak historically. And as you know now, if you've been watching these videos for any length of time, we look at that now. And now we're going to add this week what's called all loans and leases. This is everything. This is about $9 trillion in public debt. Now, I mean private debt. Let me not public sector, but private sector, people like you and I in businesses and whatnot. The total amount of that private debt is $27 trillion. Commercial banks, large commercial banks, hold a third of it. So we kind of can use what's being held at the large commercial banks as a proxy for what's going on everywhere else. After all, it's unlikely that a small community bank is going to fund a very, very, very large loan. I mean, if you're looking at millions and millions of dollars of borrowing, you're going to go to a bigger bank. I mean, it's just the nature of how it works. So as we look at this and we see credit growth is very, very slow. In a debt-based economy, you have to ask yourself, what will get someone to go out and borrow? Would you run out and borrow? If you were thinking about buying a car and it was like, yeah, maybe in a year or two I'll buy a car, but interest rates are 10%. You're probably not going to run out and borrow. You're probably not going to buy one. Maybe you're like, 10%, I'll just go and take mine in and have some work done on it. But that's why in a debt-based economy, interest rates need to perpetually decline. Now, they don't have to decline evenly. I mean, it'd probably be better for the system if it actually did. If you really understand how debt-based economies work and how the monetary system works, you kind of want perpetually declining interest rates. And that's why every time interest rates go up or there's a Fed tightening cycle, it breaks the system. And we don't see it here in the U.S. quite yet because, one, we're still euphoric about the future. You see that in the sentiment data. People are they're uncertain about today, right now. But if you kind of get a glimmer of the Black Friday spending, what you see is echoed in the sentiment data that people are optimistic about the future. That's like 6 months out. They think, okay, things are going to get better, so it's okay if I spend now. The problem with all this is the monetary lags are deep, and we're still in the 30 billion flavor of monetary lags. We haven't even gotten to the 40 billion or the 50 Bs, as President Trump tweeted about, hey, we stopped the 50 Bs. We're not there yet. But the global economy, you look at China, South Korea, Japan, whose big production economies, they're big industrial production and exporters, they're hurting. And it's only going to get worse due to the dollar liquidity shortage concocted by the Federal Reserve, who has pumped about $600 billion into the economy in the last 4 months and is having virtually no effect, and it's not working because literally the drain on the bathtub, right? I mean, just picture in the bathtub, it's literally, and you've got the faucet cranked up full blast, and it's still the water level's going down. That's how bad this is. It's terrible. So we should not see at this stage of the game, if we go back and look at the last two recessions, we did not see credit demand so weak. You can go back to, say, the dot-com bubble, and you saw commercial industrial lending contracting, but the housing market was still fairly strong. You go back to the housing bubble and you see, well, okay, even though it was a bubble, the lending demand was still somewhat strong, but commercial industrial lending and other loan growth was still okay. This time it's all bad. It's all near zero, and it shouldn't be. It should not be this low. Let's get into some charts. The M2 money supply growth rate was down to 7.26% from a year ago. It's still running very, very hot. 6-month rate of change is suggesting that we're headed to almost 9%. 3-month rate of change is echoing that. So this is very strong growth, but there's a lag to this. And if we have time, I'll show you what I've been working on. I'm not 100% that it's correct, but it kind of looks correct. Looking at real estate loan growth, it's about roughly flat from last week at 3.58%. 6-month rate of change is at 1.5%. The 3-month rate of change ticked higher. And I'm going to go on a limb and say that going into the Thanksgiving week, there were probably lenders and borrowers that were trying to get things done. So I'm going to imagine that in the next couple of weeks, we're going to see a dip in the data, because I'm guessing that there probably weren't many loans signed on Thursday of this week, and probably not many today either. Commercial industrial lending growth rate dropped from 3.7 to 3.21% from a year ago. The 6-month rate change keeps blipping back and forth between plus and minus. So I've added the plus symbol here. I normally don't put that on these, but just because it was at minus 0.03%, now it's a plus. So it's effectively at zero. And the 3-month rate change went from minus 1.02 to minus 1.91. But technically it's rising, but it's still contracting. I mean, this is bad. This is consistent with recessions. It's consistent here. The housing bubble or housing mortgage bubble burst before commercial industrial lending contracted. Here it is contracting. That is what happens during recessions. And you look at the total loans and leases and bank credit. This is $9 trillion of lending at commercial banks. The growth rate is down. Now, we don't have this from last week because this is the first week we've added this, but it's down to 4.74% from a year ago. The 6-month rate of change is at 1.82, still suggesting the 12-month rate of change needs to come down. And the 3-month rate of change is at effectively 0.8%. It's up a little from, those two are up a little from last week, but this growth rate is really, really low. And you can go back and look at the last 3 recessions, 1, 2, 3, and you can see the year-over-year rate of change barely contracted until well after the recession was over. After. That means the 3-month rate of change didn't contract until probably mid-recession-ish. Yeah, and it's about there now. So this is dangerous in a debt-based economy. And it tells you the same thing that I've been saying for a while now, is interest rates are too high. They need to go low enough to create enough lending demand. And in a 0% interest rate world, you've got to make a lot of new loans to offset all the money being destroyed from all the 0% loans you just did. Looking at credit card growth rate, with interest rates on credit cards here are 20-25% now, you would expect to see that this number is going down, and it is down to 4.1%, but I'm hearing big numbers coming out of the Black Friday online sales. We'll see probably next week what that's all about. But what's interesting is not only are people appearing to spend this right now with interest rates being real high in credit cards, the data says they haven't paid their debt off from last year yet. So that's quite interesting to me. So let's switch over to here while I get all of this cleaned up out of the way. I want to, let's just dig right into the data. Look at the assets and liabilities, the commercial banks breaking it down. So the securities and bank credit in terms of bonds, banks shed 1 billion bonds last week, so not much, and yet interest rates went down. So it just goes to show that lending demand is key here. Even if banks aren't buying a whole bunch of bonds, it doesn't matter. It helps when they are, but it doesn't really matter because in the end, interest rates and debt-based economy are based on demand. So we see Treasury and agency securities drop by $1 billion, virtually everything else for the most part. We see a drop in Mortgage-backed securities dropped by $1 billion, but virtually everything else was unchanged. So that was the $1 billion loss. Let's look at all loans and leases. We see that here's your $8 billion increase in loans. Where did that come from? Well, it didn't come from commercial industrial lending, which dropped $2 billion last week. It came from real estate loans, which grew by, you got it, let's see, 8, 9, 10, $11 billion. No, $12 billion. So we see a decrease in residential, or in most of the increases in residential real estate loans. Revolving home equity loans, I didn't even notice this in the past, but this has gone down. So either people are paying off their equity lines or they're rolling them into fixed mortgages. Hopefully if they're both, but we can't see that here. Commercial real estate went up a little bit. Consumer loans are flat. And for my stepson who sells cars, he will probably be disappointed to see that our loans are flat all month. No growth in car loans. So that is obviously not good for the auto industry, but not a surprise if you know how bad car sales are doing right now. So let's take a look at institutional money funds. This is a breakdown in part of the M2 money supply. And you can see that going into recessions, there's generally an increase in money going into institutional money funds. What does that mean? Institutional, think brokerage money market accounts. So big investors moving big money into money markets, selling stocks to put in cash. And you can see this rise here. This is what is the big driver of the M2. And if we go and look at a percentage change from a year ago, you can see, wow, it's really increasing, which is consistent with prior recession. So it's definitely, this is where the money supply growth is. This is not real economic growth because people generally do not take money from their IRAs, pension funds, and whatever and run out and spend it. And if this was money in savings accounts, that would be different. But this is institutional money funds. So this is more investment dollars than anything else. All right, let's go and take a look at the NASDAQ McClellan Summation Index, which is peaking here and kind of matching the stock market trying to peak. So liquidity conditions still remain very tight, as we know by the bond market. And then as we look at the bond market, I want to come back to this. So let's shift into some charts. And then if we have time, I'll show you the other thing that I've got for you. So stock prices closed a little bit lower today to fill a gap. Let's take a look at Treasury yields. This is really where things are more interesting to me because the bond market is now, as of next week, will have led the stock market for 14 months straight. That will tie the record. And again, anytime you get the Treasury yields falling ahead of stock prices, generally stock prices fall following that. And the bigger the gap, the harder the drop. And that means that stock prices are at some point headed significantly lower. But what you can see is these two solid lines that go back to the major support level of 2016. So we go in here on the weekly chart and we can see in 2016, this is where the sellers were at. So a lot of sellers right in here. So this is a key spot. Sellers are hoping that there are sellers here today. And buyers are hoping those sellers are out of money. So what happened here is we got it dipped through what's called support. This is a level of support where sellers are at. Sellers came in, but they were very, very weak. Came back down. Sellers tried again. They were weak. And then all of a sudden, you break through support. And when you break through support, support switches teams and becomes resistance. And so what happened then is interest rates went up and knocked on the door at resistance and said, hey, anybody there? Are there any sellers? And there were none. And then today, it drove really hard. You could see sellers came in and was like jam, 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 jam. None. And then all of a sudden, seller exhaustion and interest rates went back down and it knocked on the door again. Now, you'll hear me say that if you knock on the door enough times, you'll break through, but not usually right after there is a switch of teams. So here's a perfect example. When interest rates went down here, you look like we were going to go from support to resistance, and it moved right back through. So no, that all that says is, well, resistance pretty much held. So right now, we're looking at a team change where support is becoming resistance, and this little move higher up here is knocking on the door to say, hey, any sellers, any sellers? And the answer is not really. And that means interest rates will then need to go down. The next major move is they have to break through this level right here, which goes back to just the 2 days ago. But beyond that, it tells you this thing's most likely going to make another run at its all-time high to see if there are sellers there. And if there aren't, then it breaks through and you get a massive bull market breakout in treasury yields that are going to go to new all-time lows until you see interest rates low enough to spur lending growth. So looking at 30-year yields, we see they're under their 100-day moving average, under their 50-day moving average. Those are both bearish in terms of yields going down. So and looking at 10-year treasuries, we see they're over both their moving average, but we know, and we look at 5 years, they're over theirs, but 30-year yields are leading the market down because there isn't demand. You've seen that in the credit data. When you're seeing, quarterly growth rates at 0 point something or negative, it tells you there is no demand at these levels. You want to see those quarterly growth rates. You want to see demand. You want to see 1.5%, 2% growth rate on the quarterlies, and then you'll see interest rates go up. Energy sector took a pretty big beating today. Let's look at oil and gas producing stocks, and you can see they did not make a new closing, they did make, I'll say they look like they made a new closing low, but not a new intraday low. And that is bad news because as oil and gas producing stocks head lower, they guess what the broad economy is tied to. Here, I'll show you in case you don't recall. Here is the S&P 500. We'll zoom back out and you can see there's a nice relationship, and you can see that relationship broke here, which suggests that the S&P 500 needs to come down. And we can also see that same relationship with 30-year treasury yields, but I think we have to go back a little farther. I think with 30-year treasury yields, we can kind of suggest, actually I wanted to look at 10s. That's the big correlation. 10, 10, 10. You kind of see they're matching up on these lows right roughly in here-ish. So what it tells you is stock prices are up here. Treasury yields are down here. They need to be running roughly, not perfectly in line, but they need to be running the same direction. This gap needs to close. This is what are called alligator jaws. So here's the teeth. Here's the teeth. The mouth needs to close. So either yields need to go back up to their all-time high, or stock prices need to go back to their 2016 highs or lower. And if yields break down, well, they're headed much, much lower. And if we look at this from the oil and gas producing stocks, you can see as we zoom back into the 2-year, it just confirms that. It's saying, hey, stock price is way too high. Something's wrong in the oil patch in a big, big, big way. We can look at ExxonMobil, which is a very widely owned stock, and you can see it kind of follows along with the market there, and it broke. It's telling us again that the S&P 500 should be at 2,500 or less, and with Exxon, you've got this huge base of support that we have to go to the 20-year weekly chart that sits here now at $67 a share. That you start getting under 67 and really under 65, that's where it breaks down. But you can see it's losing momentum. There's people are selling, but the buyers are getting weaker and weaker. And if this thing starts to break, it will break down at some point. ExxonMobil is so widely owned, it alone could trigger a big sell-off in the market, especially when you're talking a topping pattern that goes all the way back to 2006. I mean, this is probably the biggest topping pattern in the history of the market is sitting in ExxonMobil stock, which is great news because if you understand the oil market, you want to buy oil as an inflation hedge potentially down the road, or oil stocks, but they're going to be so cheap, it's going to be really easy to make money on these things, but it's not the right time. Ag commodities closed over their 200-day moving average. They're flirting with that as the 50-day rises. This is a good trend as it's quietly pushing through some of these short sellers here. Then it's going to get into some heavy resistance in here, but with crop conditions not good and bad weather all over the place, we'll assume that this will continue higher. Taking a look at TLT, which is a long bond, 20-plus year treasuries, So you see that bull flag pattern? Remember everyone here, panic, 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 this thing's going down. I said, no, no, no. Closed over its 50-day, closed over, tagged its 100-day and bounced off of that in a pretty strong move. But it's sitting right here under this dotted purple line, area of resistance, but it's got to break through here. And then, like I said, you've got all these gaps. There's gaps all the way in price gaps here, here, and up here that need to be filled. So it's going to take a run at its all-time high. And I think the next time it does break through. But if this was going to lead to higher interest rates, this thing should have, historically, this thing should have broken down a lot sooner than now. Should have. Gold mining stocks. We can see where the buyers are at right here on the junior miners at $36 a share. There's going to be a big buy in this down the road. But based on another thing you're going to read next week, you're going to see that this should head lower. And so we know where the sellers are at. The sellers are right here between, around $39 a share. So we'll see if the buyers have the strength. So how do you interpret what's going to happen here? Well, we don't know. We know where the buyers are at. We know the sellers have been up here, but the sellers have been coming in at a lower and lower and lower level. So the question is, who wins the battle? Do sellers come in and push through and the buyers run and it runs out of buyers and goes down? Or do buyers push through the sellers and where the sellers are just done selling and then prices go higher? We don't know. But given the fact that these bounces on the buy are getting weaker and weaker, kind of give us an indication who's in charge at the moment, and that is the sellers. Again, I think there'll be a big opportunity here, but not till some of these gaps down here are filled, and the Fed is doing a lot more than $60 billion a month in bond purchases. They've got to. And then taking a look at the dollar, it's quietly rising, which is also helping interest rates go down, because when the dollar rises, which it should be in this right now, it leads to tighter financial conditions. So you have the dollar tightening, plus you have interest falling, which is signaling tight financial conditions. And you see the Fed's easing here is not working at all. So let's see, what else do I want? Well, let me show you that other chart that I've been working on. Oh, let's go and look at this. This is what I meant first. So here you see the Wyckoff accumulation events. You see up here this last point where it's scissoring back and forth, up and down, up and down. And again, this is the final accumulation phase before it goes higher. Does it kind of look like, again, what we see? You can't see that. Let's go. Oops. Nope. Does that look at all? Now I am on the wrong spot. Here we go. Does that not look like this right here? Yes, it is. That's why I said this is not a bearish pattern for bond prices. This is a bullish pattern because it's the final accumulation phase. And we know, look, the banks aren't selling bonds, so that also tells you what's going on there. You know what? Let's just save that other chart for maybe next week, and we'll see what we get on Monday when we take a look at how hedge funds managers are positioned. And we'll see what the economic data brings us in the new month of December. But with Treasury yields front-running stocks for now 14 months, again, that as of next week, that will tie the all-time record. Well, guess what happens? Every time Treasury yields front-run stocks lower, you get a recession. And the bigger the lead, the bigger the drop. And it's only a matter of time before U.S. investors wake up to the reality of the global economic data, or that the global economic data is getting worse, not better. See, investors were betting on that all this decline in economic data was transitory, that they believed it, so they bet on it. It's not transitory at all. So I'm Steve Van Metre. Hope you and your family had a wonderful Thanksgiving, and we'll see you next week. Bye now.